Okay, so you've seen the headlines. Markets are rallying, AI stocks are mooning, and everyone's screaming new bull run. But in the middle of all that noise, one of the smartest hedge funds on the planet, Tiger Global, just made a move that has Wall Street seriously nervous. They're selling. Quietly, strategically, and fast. So what do they know that we don't? Is Tiger Global betting on a crash? Let's break this down. Over the last quarter, Tiger Global unloaded hundreds of millions in software, fintech, and high-growth consumer tech positions, the same categories that powered their comeback just a year ago. Companies like Shopify, CrowdStrike, Datadog gone or significantly reduced. But the strangest part? They sold while most funds were adding. It's completely against the trend. So here's what insiders think. Tiger isn't panicking, they're hedging. This is what they do best. When retail investors think the market only goes up, Tiger starts reading the warning signs, and right now those warning signs are flashing everywhere. Overextended valuations, slowing cloud growth, and massive concentration in just a few AI names. Think about it. Nvidia, Microsoft, Amazon, they're carrying the entire S&P 500. But what happens if one of them stumbles? The whole thing wobbles. And Tiger Global has seen that movie before. They got crushed in 2022 because they stayed too long in overvalued tech. This time, they're not making that mistake again. Here's where it gets really interesting. They're not just selling random stocks, they're rotating. Tiger's quietly moving billions from high-multiple software plays into what they call defensive AI infrastructure. That means companies with hard assets, recurring revenues, and lower exposure to hype cycles. Think chip manufacturers, cloud infrastructure, and even energy providers that support data centers. So yes, they're betting on AI, but they're also betting against the bubble forming around it. It's a balancing act, and it's brilliant. While everyone's chasing the shiny stuff like AI apps, Tiger's quietly building an insurance policy in the background. Now let's talk timing. This sell-off didn't come out of nowhere. It started right after the latest tariff announcement between the US and China. That policy hit semiconductor supply chains hard, and guess who predicted it? Tiger Global's macro desk. They started cutting China-linked exposure weeks before the announcement hit the news. When the market tanked that day, Tiger didn't flinch. They'd already repositioned. And here's the other red flag they're watching: liquidity. The US consumer is starting to weaken, credit card delinquencies are ticking up, and corporate earnings are showing cracks. Tiger's internal AI model, the one they called the Pulse, started flagging slowdown signals in August. The model analyzes thousands of earnings reports and macro indicators in real time, and apparently it's been flashing yellow for months. That's why insiders are saying Tiger isn't just trimming, they're preparing. Preparing for what could be a correction or even a short-term crash. But here's the genius part. They're not scared of a crash, they're waiting for it. Because that's when they go shopping. Every time the market dips, Tiger Global has a playbook. Buy dominance, buy data, buy infrastructure. They did it during the dot-com crash, they did it during COVID, and they'll do it again if 2026 starts rough. It's like they're always one step ahead of the panic. Now look at this. According to their latest filings, Tiger cut over $700 million worth of software stocks, but added roughly the same amount to data center energy and semiconductor manufacturing. They didn't retreat, they just shifted the battlefield. And that tells you everything. They're not betting on doom, they're betting on rotation. Still, there's a message hidden in that move. Tiger thinks the easy money in AI might be over, at least for now. The hype is peaking. The retail crowd is piling in. You're seeing headlines like AI stocks to buy before it's too late. That's exactly when professionals start taking chips off the table, and honestly, they might be right. Every major rally in history, dot-com, crypto, even EVs, ends with this same pattern: euphoria, concentration, overconfidence. When everyone's sure it can't go down, that's when the smart money starts leaving the party quietly. What's crazy is Tiger's not alone. Other big funds, Bridgewater, Millennium, even some sovereign wealth players, are quietly trimming tech exposure too. But Tiger's just doing it more aggressively, probably because they remember the pain of 2022 better than anyone. So yeah, maybe they're betting on a crash, or maybe they're just setting up to profit from one, because that's the other side of Tiger's strategy. When everyone's losing their minds, they start deploying capital like crazy. It's what they call counter-momentum entry. When the panic hits, they buy what everyone else is dumping. It's almost poetic. The same hedge fund that was destroyed by volatility is now using volatility as a weapon. They've turned fear into a signal, and their AI helps them time it perfectly. The moment sentiment hits maximum fear, the system starts flashing green, and Tiger strikes. So what does that mean for us? It means the market might be due for turbulence. It means the biggest, smartest money in the room doesn't fully trust this rally. And it means if a dip does come, and it probably will, Tiger's going to be waiting, checkbook in hand, ready to scoop up the next generation of winners. It's easy to get caught up in the hype, AI breakthroughs, record highs, bullish headlines, but moves like this remind us that even in 2025, the fundamentals haven't changed. Markets move in cycles, and right now Tiger Global's playing the cycle like a grandmaster. So yeah, they might be selling, they might even be betting on a crash, but don't mistake that for fear. It's strategy, cold, calculated, and tested through fire. Because the truth is, Tiger Global doesn't bet on the end of the market, they bet on what comes after, and if they're right, again, this quiet sell-off could be the setup for their next billion-dollar win. So, what do you think? Is this just smart risk management, or are we about to see the next big correction hit tech? Let me know in the comments, because if history repeats, the next move Tiger Global makes could change everything we think we know about this market.